Hey, hope you're having a good week so far. We have a lot to cover here this week. Last week, we had talked about covering the GDP numbers, so we're going to get into that. We've got kind of a new tone from Fed Chair Powell here today. ADP employment reports came out, and our question of the week, thanks to you guys and sharing what's on your mind, is all about year-end tax strategies as we gear up for November already. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group here in Bellevue. And as always, our goal here this week is just to bring to you some of the market news and things that we're watching that you may actually be able to use to implement and make your portfolio a little stronger, and hopefully weeding out a little bit of the noise as well. I actually just got back from Hawaii on Sunday, so you probably can't tell, but it was very nice to get a little bit of sun for a change. Always about this time, like October, November, I feel like I am just beat up by the rain that we have here in Seattle. So very nice to get a little bit of sun. But anyways, back into it. So let's kind of jump right in. So as we had talked about last week, there was a lot kind of rolling out before I had to take off there. And one of those things was income numbers, which were down a little bit, inflation still running high, and spending was slightly up again as well. And I think, again, a lot of that may have to do to some degree with the inflation numbers that we're seeing. So kind of factor that in, think about where those numbers may be coming from. But the biggest thing I wanted to cover before we get into this week's news is the GDP number on Thursday. GDP number came out at only 2% last quarter growth. Not good at all. The previous quarter, I think, was like 6.8. To see a 2% growth in GDP with everything we've done, with all the spending, with this coming out of this recession, like all these factors that should just propel us forward, it wasn't good to see it at 2. And in fact, some of those expectation numbers kind of kept pulling back and back and back as we got closer. The expectations were still at 2.8, and we fell even short of that. So not good to see, well below expectations, again, significantly below last quarter. But somehow the markets seem to just kind of shrug this off because no big deal. I think part of that, for those who followed us last week, is probably due to earnings. Earnings have been very strong, kind of across the board, really. But, earnings have been strong again here. And so that may have something to do with the ability to kind of shrug that off as if it's no big deal. But it is something to watch. I mean, that is a really bad number. Doesn't necessarily mean that the profitability of the companies is falling, but we want to see that number continue to pick up, especially as we pull out of this recession. All right, moving into this week, we have a lot as well. On Wednesday, we had Fed Chair Powell speak, and again, a little bit of a different tune this time. He seemed a lot more humble about inflation. Seems like the definition of transitory has certainly changed since he originally had kind of rolled out that word and kind of pounded his fist as far as inflation numbers being transitory. So a little bit different here this time. Continue to talk about the same things. It sounds like we will be tapering. Sounds like interest rate hikes are way down the road, but a little less confident in the forecasting around that transitory inflation picture. So still, I guess not a lot of change. The markets certainly liked hearing them. They were down, and then Fed Chair Powell came on and picked right back up when he said, basically, we're not doing anything for a while. So definitely keep an eye on that, though. It was very clear, I think, today that he's a little less confident in those transitory inflation measurements or forecasting. So I know we've been talking about this forever, but I do still, and I think this was a good sign that inflation may be around for a bit. Maybe not as high as it is today, but nonetheless, a little higher than we're used to. Let's see. We also had ADP employment numbers come out today, added 517,000 jobs based on that. For those who know and follow this each month, really the ADP employment numbers, we don't take a lot that into account a whole lot. It's a good sign of where things are going, but those numbers can be a little off. So the big numbers to come on Friday. On Friday, we've got non-farms payroll, and really want to pay attention to that. I'm curious what you guys think. You think it'll be a good number? You think it'll disappoint like last month? For those who remember, last month, non-farm payrolls was terrible. We only added 194,000 jobs. And I think we were expecting, if I remember right, close to like 600,000, or it might have even been higher than that. So let me know. What do you think? Do you think we're going to have a disappointing non-farm payrolls? Do you think we're going to be in a good place? My perspective is I think personally we may see a really big number here finally. I think last month the numbers of people getting back to work with unemployment ending and all that stuff had kind of been skewed with some other things. So very interested to see what happens here this month. And for everybody's sake, let's hope we have a good non-farms payroll. Let's hope we got some people getting back to work here and good jobs market, which will have an impact on the Fed too. So we'll kind of tie that in as maybe we learn more. Coming up next week, we've got, again, non-farms payroll tomorrow. So really pay attention here. We've also got unemployment. And then we also have CPI numbers. So inflation numbers coming out next week and a holiday on Thursday. So Veterans Day on Thursday. So looking forward to celebrating Veterans Day, but yeah, non-farms payroll, unemployment, and inflation numbers all next week. With that, we'll go ahead and transition into our question of the week. And as always, if you guys do have any questions for us, please reach out. Let us know what's on your mind. We'd be happy to help answer your questions and just kind of share our thoughts on whatever you're mulling over or starting to see in the news or whatever it might be. This week's question of the week, excuse me, came from a lot of you guys. So thank you so much for voting on our poll recently about what you wanted us to cover. The top topic was year-end tax strategies. So I'm going to touch a little bit on that. And what I will say before I go too far down that path is we've got a online learning workshop coming up on November 18th. So we're going to be talking a lot about year-end tax strategies at that point, some planning things not only on the tax front, but elsewise as well in terms of what you can do before year-end to just put yourself in a better position, maybe get ahead of some of the tax changes that may be coming. But either way, we'll cover it briefly here today too. There's a lot that's coming up especially for those of us here in Washington State. We've got potentially a capital gains tax coming up. We've got the long-term care tax. We have potentially capital gains tax raises nationally. We've got the potential for a federal estate exemption to decrease. And then a lot of changes potentially on the Roth conversion front. So I'm going to skip the Washington State stuff, talk more nationally for now because we have talked a lot about the Washington State stuff. If you're not familiar with that, go check out my profile. Maybe you can grab a little more information there too. But federally, there's a lot of changes. So there's a lot of talk about decreasing or reducing your ability to convert Roth to pre-tax, especially for higher income earners. For those who have 401ks, decreasing your ability to convert after tax to Roth. So we really want to pay attention to that. It doesn't necessarily mean you should kind of uproot and change everything, but definitely, if you find yourself in that boat, it may be wise if you were going to convert anyways to consider doing some here this year, not to shoot yourself in the foot by, increasing your tax bill significantly, but if you were unsure whether you're going to do it this year or next, and it's really not going to impact you one way or the other, it may make sense to explore it. The other thing that I wanted to touch on is the estate exemption. So they're potentially talking about dropping it from 11.5 million to decrease it a bit. If that is the case, year end is a great time to consider maybe gifting, to consider some sort of strategy to maybe reduce your estate, because that would reduce your gifting exemption based on the old amounts, the amounts today in 2021. Now, again, don't throw the baby out with the bathwater here. If it doesn't make sense, do not do it. But if you're starting to explore that, it may be wise to just get ahead of it anyways, do it this year, and it may give you a lot more giving opportunities in the future and keep your estate exemption high. Biggest key. So those are some of the big things that we're watching. And certainly we'll be covering a lot more of this again coming up on Thursday, November 18th. So if you do want to join us for that session, just reach out. Maybe I'll include a link here in the comments as well. But reach out and we'd be happy to have you join us. We're going to be talking about a lot, especially on that estate tax exemption coming up on November 18th. Thanks as always for joining us. We'll see you next Thursday at 3 p.m. and definitely let us know if you have any questions for us to cover next week.